You are not going to want to miss the information we're talking about in this video because this is a total game changer and it's not what you're expecting. Probably, at least. See, the market has rallied 8 days in a row. Had we closed green today, we would have had 9 straight green days in a row, something that has not happened since the market rally in 2004 coming out of the dot-com bubble collapse. Well, today the rally failed its 9th day, and the questions we have now, well, come down to a lot of problems. One, what's this Bureau of Labor Statistics labor revision everyone's talking about? Are we going into a recession or are we in a recession? Where's Kevin on the bear bull scale? I mean, the market's been going up the last 8 days, so surely he's going to flip-flop to bull, right? Well, we're going to talk about that in this video. Is the market pricing in any quantitative easing or a stimulative Fed at all? And will the Federal Reserve go with a 50 BP cut? Or frankly, has the Fed already gone too far? We're going to talk about all of that and much more in this video. And boy, there's some big things you want to take notes on this one. But first, I have to get it out of the way, like this stain on the jacket over here. It'll wash away. I've got this $1 million trade that I've built up. And if you want to know exactly why I built it up and what it is, actually 2 trades, one part and another part, both of them are equally worth over $1 million, and they're trades for the second half of this year. I consider them both hedges and, frankly, a long-term investment. They're not puts, don't worry. But anyway, if you want to learn more about those and my strategies around those, why I'm looking at these, make sure you're part of the courses on building your wealth. We've got a coupon code expiring this Friday for Jackson Hole. So it's a special honorary Jackson Hole coupon code. Haven't pitched a coupon code in probably a couple weeks here, 1 to 2 weeks, something like that to all of you. So just wanted to mention there's an opportunity coming up for Jackson Hole. And that's it for the mention for now. Let's hop on to the content. The research institute Mizuho is nervous about employment. They see slowing hiring, soft household employment data, softening payroll employment, and rising unemployment. And their question now is, how much is inflation going to weaken, and how much is the jobs market going to weaken? And their answer, a lot and a lot. And their critical takeaway in their article was that the Federal Reserve is priced right now for a, quote, decent easing cycle that would only take the Federal Reserve to the top of the neutral end of where the Federal Reserve rates might actually end up in the long term. And this, they say, is actually somewhat problematic. I want you to see this. I'm going to throw this up on screen right here. This is a screenshot of what they're saying. And I wrote on the left, basically, no stimulus priced in. And I'm not talking about stimulus checks. I'm talking about the fact that the Fed is restrictive right now, and the market is only pricing in the Fed going to neutral. Well, if the Fed needs to go stimulative, rates can fall a lot further than currently priced. And this, in their opinion, suggests that investors should continue to buy backups in market rates. Now, what the heck are those? Well, backups in market rates are basically a way of saying, hey, maybe you want to buy treasury bonds or something that's going to lock you into higher yields. Because if the Fed needs to go to, well, frankly, just neutral, cool, that's priced in. But if they need to price in any amount of easing, that hasn't been done yet. And so on top of this fear about the employment cycle rolling over, we've got big employment data tomorrow. Big employment data tomorrow that, quite frankly, is probably going to show the economy is a lot weaker than we had originally thought. On benchmark revisions, this is what they're called, Bureau of Labor Statistics benchmark revisions. They come out at 10 a.m. on the morning of, what do we got here, Wednesday the 21st. Mizuho suggests we already have most of the information. It's not going to be a huge surprise that the revision is going to be massively to the downside. In other words, we created way fewer jobs than we actually were told we created under the Biden administration in the last year. Not a surprise, and it's not designed to get political, it's just the way it works, except these revisions are probably going to be in the magnitude of 1991 or 2009, both recessionary periods. Goldman Sachs thinks the number is going to come in around 600,000 to a million. Mizuho thinks the number will come in as high as 1.1 million in terms of a negative jobs revision. So in other words, you take the total bundle of all the jobs we created over the last year and now take out up to 1.1 million, or nearly 100,000 fewer jobs per month. That would be in line with the weaker household survey. That's why we keep seeing that spread between the payroll survey, which asks bosses how many employees they have, and the household survey, which asks household, do they have a job or not? And those surveys have kind of been widening, suggesting there's something wrong with the data. Well, these revisions might finally kill the charade, at least for now. Now, a lot of people think the gig is up, or the jig is up, and we're going to see some really bad, potentially recession fear-inducing numbers at 7 a.m. California time tomorrow, or 10 a.m. It's interesting. It gives you 30 minutes of trading right before that, or 10 a.m. Eastern time. Goldman, though, doesn't actually think it'll be that bad, because Goldman thinks the downward revision will be overstated, mostly because it might not count all of the work-authorized illegal immigrants now adding to jobs. Though I think most Americans are going to listen to what Goldman said, and they're going to say, bro, if we're now relying on illegals with work authorization to prop up our economy, then our economy truly is effed. But anyway, Mizuho says that this report tomorrow is likely to contribute to a downside yield and curve steepening risk. Now, I can't give any guarantees. I have no idea what's going to happen. Past performance doesn't guarantee future results. But I've got a big trade going on this, and that's my $1 million trade. So we'll see which way it goes. If you want to see what it is, make sure you join before tomorrow when that release comes out. You can just go to meetkevin.com. If you need a bundle coupon, email us at staff@meetkevin.com. This isn't like a YOLO trade either, where it's like, oh yeah, it's like a Friday call option or some YOLO that's going to go to zero. This is my opinion, a real trade. But anyway. Since there is one more employment report before Jackson Hole on Friday, Mizuho thinks that the Federal Reserve is actually going to leave the door open to aggressive easing from the Fed. This kind of aligns with what Evercore ISI suggests, which is that we might see a Fed suggest a 50 basis point cut in the September meeting, especially since the September meeting is also a signaling meeting where we get the summary of economic projections, where they could give us a 25 or a 50 and potentially talk dovishly about the market to really drive yields down quickly and aggressively. It's a big trade in that. You should be seeing it loud and clearly. But anyway, something to watch, though, is the layoff rate. Okay, the layoff rate is right now still under 1. Now, don't worry. I know that doesn't really mean anything to you right now, so I'm going to give you history. Historically, the layoff rate sits around 1.2. with full employment. That's your layoff rate. If hiring keeps falling, though, and then all of a sudden you get a normalization of the layoff rate, in other words, hiring falls and the layoff rate rises just back to normal, Mizuho thinks you could see the unemployment rate move sharply higher, which would move you into a recession. Notice everything, even though we've had a good week here with lagging data, unemployment claims, University of Michigan sentiment, PPI, CPI, export prices, who cares, right? All of this lagging data. The leading indicators, like job openings we're going to talk about and some of the other things you'll see in this video, they're actually weakening. They make me more bearish. And there's a reason I haven't made an economic video in 4 or 5 days, because I've been reading and studying this every single day to put this video together to just give you a calm, put together perspective that's hopefully balanced. I know some of this sounds negative initially to start with, but we're going to balance it because I'll show you why this could be wrong as well. But anyway, Mizuho says that if the labor market weakens, it would be reasonable to assume that the Federal Reserve is going to need to add stimulus. That is, they're going to take rates below 3%. We're not going to be neutral. We're going to go way below that. And the market's not currently pricing that in, especially since when you have the basically jobs added level sitting around 90,000, you're kind of looking at periods historically that align with either recessions or really soft labor markets. It's also worth noting that the job openings rate that a lot of people talk about, which I will show you a picture of right here because I keep seeing it on X. People keep posting these job openings rates and they say, oh, the last 2 recessions started with 0.8 and 0.6 job seekers per jobs per seeker, basically. In other words, you had way fewer openings than you had workers. Well, right now we're sitting at like 1.2. So people are like, see, we're not in a recession yet. But there's a problem with this chart. Publications like, I can't remember which one it was either Rabobank or TS Lombard, they've suggested that the job openings rate may be artificially high because companies just forget to take down their old and stale listings. And the web portals actually incentivize people not to take down the listings because the longer those listings are forgotten, the more profit those companies get. And the job listing websites are already getting smoked because we have such a soft labor market right now. So they're like, no, please don't cancel your listing. We need the money. So in other words, this line could already be in a recessionary level, and we just don't know or see it yet because, A, we don't want to, and B, well, frankly, we use the internet, ironically, to find jobs a lot more today than we did, yes, again, ironically, than in the dot-com bubble and in '08. Everybody's got an app now to find a job. We didn't even have an app store in 2008. The app store for Apple came out in 2009. I remember it. It was in the summer of 2009 as hanging out at Lauren's house. Anyway, this really suggests a downside bias to this chart. On top of that, you've got BCA research that currently thinks we could be pricing in a year-end recession. Listen to this. Ahead of recessions, firms usually reduce the pace of hirings before they start firing. The JOLTS hiring rate is now well below pre-pandemic levels. See, that's a leading indicator. Hires tabulated by these various different firms were down 43% in the first 7 months of the year relative to the same period a year ago. Folks, a 43% decline from a year ago. On top of that, the job opening rate today is flat from its post-pandemic peak of 7.4 to 4.9%. Our global investment strategy team highlights the current pace of decline in the job openings level. At this current pace, rather, the economy will reach the, I'm just going to translate this to English, the bad point in the Beveridge curve. And at that point, rising unemployment will trigger a negative feedback loop, self-fulfilling, culminating in a recession. Now, just like in super plain English here, when people start firing, they start firing fast. And it's no surprise that Mohamed Alarian is now suggesting that expectations of losing one's job is currently at record high levels, according to the New York Fed survey going back to 2014. Now, it only goes back to 2014, so I don't actually think that one's like super useful. But something else that is super useful, in my opinion, is considering that, well, wait a minute, what could actually be contributing to layoffs that has started occurring over the last year? Oh, what's this? Dennis on X. Brutal. Company's marketing team begins using AI. Company realizes it doesn't need the entire marketing team. 75% of team gets laid off. These, I call them AI-enabled layoffs, where basically what you have are companies that start saying, okay, we're not really growing revenues as fast, but we need to show our investors growth, so let's grow EPS. In order to grow EPS, what are we going to do? Let's just lay people off, because then our earnings will look higher from our existing book of business. Now, we'll talk about revenues flattening in just a moment. That part's still coming. But it shows you that, if you get a self-fulfilling loop, it's likely that the productivity enhancements we've gotten from AI could actually make companies more interested in laying off other people more rapidly. It's not good. All right, so then, Mizuho on inflation. Now, this is a really interesting one. So this is a special little chart they put together here. And I want you to see this red arrow right here. This red arrow points at the green line. The red arrow suggests that trend inflation actually started declining around the end of 2021. Now, this is actually crazy because it suggests that if trend inflation was going down, then it basically means we had these weird little transitory hits as to why inflation went up in 2021 and 2022, rather than sort of a long-term trend. This is critical because a lot of people believe we're just going to have a second wave of inflation. We're basically screwed. But the reality is, if we end up having lower trend inflation and all this stuff was truly transitory, then people are probably really mispositioning themselves, and they should be positioning themselves for a recession and for deflation, not for a second wave of inflation. Anyway, take a look at this. Demand inflation is right here where the green arrow is. And you can see that demand inflation sits at just under 1%. The left side is just under the 1% there. But usually we sit slightly under the 0% line. This means that when that blue line continues to normalize, we might actually see PCE inflation closer to 1% than 2%. This is according to Mizuho. I'm not making this up. This means the Federal Reserve might actually have already overdone it. Inflation might end up closer to 1%, and we'll be right back at flexible average inflation targeting, where the Fed's trying to get inflation back up again. And then we get to 0% interest rates, QE, and we're right back to the bubble cycle, except a bunch of people lost all their money in the stock market crash on the way down to that cut to zero. Like I said, I don't want to be a bear, because I feel like I'm like talking down people's portfolios or whatever, and people are like, oh no, it's bad. I was like, well, as long as you don't stick your head in the sand, have an opinion on it. It's important. But all of this is also consistent with what T.S. Lombard is seeing with European inflation as well, suggesting that shipping rates appear to have peaked, insurance rates appear to have peaked, disinflation in core goods has probably reached a bottom, but it's probably going to stay around there. The services inflation has probably peaked out, weaker commodity costs, all these things basically leading to fading inflationary concerns. On top of that, what you're seeing is, well, quite frankly, earnings estimates for S&P 500 companies plummeting. Yeah, not good. Look at the white line. The white line is the stock price chart of the S&P 500. The orange line are earnings per share projections, which are plummeting. So why is the stock market still going up as projections are plummeting? FOMO. Well, I mean, that's just a theory. I don't know with certainty, but that's what some are thinking. Anyway, these issues in total are problematic already, everything we've talked about. But I'm just going to add a few more things in here. Startup failures have surged by more than 60% in the past year. On top of that, we have the highest level of bankruptcies since Q2 2017 and the highest quantity of Chapter 11 filings since 2011 in the last 13 years. That's not good either. Oops. Wrong button over there. That's not good either. So, if only people were potentially starting to prepare. I mean, in fairness, we did get good news. Good news on Israel. Israel and Iran seem to have cooled their jets, quite literally. A deal with Hamas may be more imminent than strikes. We do have very low hedging happening right now. That could be explaining why the market skyrocketed over the last 8 days. Put-call ratios are at the lowest we've seen since July of 2021, suggesting that a lot of what we've recently seen has been a bit of a short squeeze. And central banks are starting to stockpile gold, which might be why gold is over $2,500, which also kind of makes sense because, frankly, if rates are going to get cut, people think that the value of the dollar, which I think will fall about 10% very soon or more, currencies will lose value and gold might preserve its value, or if there's a recession, actually go up substantially in value. These are all bad, right? I hate to say this. So now on top of all of this, we did have a foreshadowing of this August 5th crash. And I hate saying that because it's kind of like, oh my gosh, like there was a warning sign. Tell me what that warning sign is so we can watch for new flare-ups. Yeah, we actually covered it here on YouTube. It was the spike in the SOFR rate. That's the standard overnight SOFR funding rate. And it spiked earlier in July. And it's sort of, I remember making a YouTube video on this, and I was like, this signals liquidity stress and potentially something bad that's about to happen. And then we had August 5th. So now, I mean, I didn't know exactly what was going to happen then, obviously. But now it's like, okay, now you got my attention to the SOFR rate. Now I'm going to pay attention to this a little bit more. Now, something else that's also not great is the US dollar now equals roughly as many Japanese yen as it did on August 5th. And hedge funds seem to be more interested in going bullish the yen, which means as we get rate cuts, the dollar goes down. the yen gets bought by hedge funds, which I kid you not, that's literally what's happening right now. See, look, hedge funds have finally turned net bullish on the Japanese yen. So the yen gets bought, so yen goes up. Dollar gets sold, dollar goes down. What gets worse? The potential carry trade. Yeah, so you could potentially be setting up yet another carry trade disaster. And it's just, all of this in net is just not good. Now, I'm going to do a quick summary of this, and then I'm going to leave you with some closing thoughts here, because this is a lot of information to take in. I understand that, and my goal is just to simplify this as much as possible. I do want to quickly say that you do have Goldman Sachs that gives you a little bit of an alternative view. I'm sorry, it was Deutsche Bank, not Goldman Sachs. Deutsche Bank says companies are waiting and seeing. That yes, their customers are delaying orders or pushing out or deferring orders. They're not abandoning or canceling those orders. And Deutsche Bank doesn't see signs of a recession yet. So this is kind of your flip side argument that things are just normalizing, that this is all just part of the noise and par for the course. And you would expect all of this noise in a normalization. That's fine. And it's entirely possible that this could just be normalization. But let's just say, to me, things feel a lot worse than normalization. So what are some of my bottom lines on all of this? Well, first of all, maybe check out that Stocks and Psych course. And even though I can't guarantee you're going to make money on every single trade or idea, at least you know where my head is. So when you hear or see data like this, you could look around and say, okay, well, how is Kevin positioning? How are other people positioning? And then decide for yourself. Do I want to do the opposite of Kevin? Do I want to do something similar to that or something different but take some inspiration from? It's none of this is personalized financial advice. It's just designed to give perspective. So bottom line, I'm a 2.9 on the bear bull scale. And honestly, I'm kind of starting to lean down, not up. I know it sucks to be a bear when markets are going up, but, and I mean, last week's data was nice, but the anchor here is still heavily in recessionary water, mostly thanks to declining leading indicators on jobs, declining growth revenue expectations, we've seen those turn flat, AI-enabled job firings to boost EPS, and plummeting job openings and hire rates. When the joblessness hits, it'll hit fast, first slowly and then all at once. The faster the Federal Reserve can react, great, but remember, when the Fed hit us with interest rate increases, there was a lag. What do you think there's going to be on the way down? Another lag. Good luck. I love y'all, and I wish you the best.
These things that you told us here, I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than HouseHack, nor am I presently acting as a market maker. Make sure if you're considering investing in HouseHack to always read the PPM at househack.com.